Today we'll be discussing some post-election charts. So with the election officially behind us, we can now focus on what it means for the last 2 months of the year and of course 2025 as well. So let's start by looking at this table, which has the S&P 500 total return both before and after the presidential election. So we're talking about the election year total return and also what comes next. And so as we know, 2024 is not done yet, so we don't know what this actually will be 2 months from now, but so far at about 21% total return for the year, it ranks pretty close to the top. As we can tell from a quick glimpse of some of these years here, a lot of them have come from a long time ago, 1920, 1924, 1936, 1928. So we're talking about times when it was right before the Great Depression, during the Great Depression, right after. So a lot of big numbers from there, which kind of make things difficult to see. So let's take a closer look at some of the most recent occurrences. Specifically, over the last 50 years, that means it's 1976. And if we do that, 3 of them pop up here, 1976, 1980, and 1996. Now, as we can tell by the numbers here and also colored in red, that 2 of the 3 times the market was lower the next year, so the first year of the new presidential term. In 1976, Democrat won, and the next year was down about 0.2%. 1980, Republican won. The S&P then was down about 10%, again, from a total return basis. And that leaves us with 1996. Democrat won, up 31% the next year. And as we know, 1996 was a bit different than the rest of them because that was the beginning stages, or really the early stages of what was going to be the internet boom and eventual bust. So let's take a closer look at 1996. And we're going to be looking at this in terms of the NASDAQ 100 because right now, NASDAQ 100, as we know, has been leading with AI-related companies and the like. And of course, during that time, in recent years, we've been hearing more and more about how this was like the internet revolution. It's something new, it's innovation, and the question is, what part of the cycle are we in, right? Are we near the beginning stages like we were in 1996? Or are we more closer to the top like we saw at the beginning stages of 2000? Well, the same questions were asked in 1996 as well, because this was something new. No one knew how to grasp it at the time, and there of course was a lot of greed, a lot of extreme greed, a lot of crazy things happening in terms of day trading. And at the time, the market was already up 130%. The NDX was, from the 1994 low here. So in a very short amount of time. And that was an extremely large move, even though we had another 400 or so percent to go, that a lot of respected officials, especially Alan Greenspan, named this irrational exuberance back in December 1996. A little premature, I'd say. However, eventually did get to that point. It was irrational, it was exuberant, and it had eventually to come in. And so if you look at 1996 versus 2024, from that perspective, again, this is where it ranks. Here's a chart of the NDX looking at the same thing, multiple years, log scale, like we saw in 1996. Clearly up a lot, but also taking advantage of bullish patterns as they formed along the way. Now we know these moves have been very extreme, but this is a closer view of what's happened. Hasn't just been straight up. At times, of course, it has. Those had to be corrected, but every time so far, we've seen a pullback, sometimes more than others. They eventually gave way to not only a rally, but the formation of new bullish patterns to take advantage of, with the current one potentially waiting to be broken out of once more. Some people do not believe this is going to happen, of course, and we're about to roll over, which, we can't argue with that possibility, and we'll see in the charts if that happens. And now, taking it from the 2018 low up 250% already. And of course, we could have taken this back at any point over the last 10 years, and this number would be bigger, but this is a good view of where we've come from, dealing with a number of pretty substantial pullbacks along the way. And so how does this really compare to 1996? Well, we can pull the starting date in 1996 back as well. In fact, not many people talk about what happened from 1990 to 1994, but this was a very substantial gain marked by breakouts, consolidation phases, breakouts again, to the point where this was that same spot which we looked at before, which was in the middle of the chart here, right? And this one looked even more extraneous and even more extended here, breaking out to new highs, right, in 1996 after an extended run of breakouts. So you can see why people didn't believe it. And so again, right now, are we in the stage with AI that is just beginning, that we have to, go through numerous phases, which gives us extended, much higher prices than now? Again, we will see, but this is a good perspective, again, especially coming after, we're in the middle of an election year where the S&P 500 and others are up so much after having been up already for a few years, just like we saw in 1996. And so let's look at this from a perspective of stock market performance per president. And I think this was an interesting perspective. I'd urge you to go to Macro Trends to check it out, because it gives you the ability to plug in any one of these, presidents and see how they did and how the stock market did. This is using the Dow during those time frames. As we know, most of the time the market is up, so most of these have a good track for the first term. Now, two things really stand out here. The first one is that the best returns came with the presidents that had more than one term. As we know, the market tends to go higher for longer, and so the ones that were in office for 8 years or longer for FDR, just on average, just did a lot better. Now, there are some, of course, times when that didn't happen, in 2000 through 2008 when George W. Bush was there. Of course, that wasn't the case. Another part that stands out is that it matters where the presidential term started, right? FDR started really, as the Great Depression was ending, and you can see how well the market did coming back from the Great Depression. And we can say the same thing, again, I guess, with Bill Clinton being there for basically the entirety of the internet bubble right before, it burst in the final year there. But for the most part, he was there for one of the best rallies we've seen on a 4 to 8 year basis in history. And so looking at this a little bit differently, looking at the stock market performance per term, Charlie Bilello, who does fantastic work for creative planning, as we all know, looks at this in that manner going back to 1929. And so the big takeaway here is just the amount of green that we see on this column here, where most of the time on a 4-year basis, whether it's presidential cycle or what have you, it's been higher, right? This is the way the market has gone. In fact, 20 out of these 24 times, which is a win rate over 80%, presidential term has been higher. Of course, there has been times when it hasn't. George W. Bush had the unfortunate experience of being there for 2 market crashes, but the rest of the time there, Charlie argues that it shouldn't matter from a stock market perspective what side wins, because you eventually do get strong prices in the 4 years there. And so that brings us to what we should expect from now the election date to year end. And no surprises, this is a chart from Equity Clock, is that whether we're in an election year or not, you tend to see positive seasonality in November and December. And so just a matter of getting through the election for the most part. And as we know from previous studies that we've talked about and others have as well, you tend to have a strong finish when you're dealing with a strong year already, right? The first 10 months of the year then typically leads to a good finish as well. And lastly, we'll look at what happens on the post-election year or the first year of a presidential term. And again, it's not a shock to see the market typically has a good year. I would say the one thing that really stands out here is that on a post-election year, we typically see, or have seen at least, the market bottom a full month before a typical year has done in the past. So talking about late September compared to late October. Now, we know things could be drastically different year to year, but there's enough data in here to show that we should at least respect the fact that if something like this happens next year, then we shouldn't ignore it. That's what we have for today. Don't forget to check out these videos and subscribe. I'll talk to you next time. Thank you.